This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a Wednesday morning, middle of the week. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, good morning.
Hi, good morning, Prashant. Morning, Nigel. Morning. And yesterday, what a knockout performance from Maxwell. I mean, it was really something else, right, what we saw on the field. And, you know, I don't know if you guys know this, but Maxwell actually had a bout with depression and anxiety many years in the past. And he's come out of that with so much glory, and the kind of performance we saw on the field was pretty much something else.
What a fighting performance, Sonia. You know, he was flat, down on the ground at select times, but he came back, he bounced back up, and I didn't know that on the personal front with regard to how he's combated depression, but what a fight. I mean, and people like us, we weren't there to see Kapil Dev in 1983 because we're not on the world, but, you know, this reminded you of something like that. India versus Zimbabwe. In 1983, 17 for 5, and we came back to win it, led by Kapil Dev. And in fact, you know, everyone was calling it curtains for Australia yesterday. 90 for 7 and 201. Wow, what a stellar knock.
Looks like I missed a good match. I was on a flight yesterday, I mean, so got back pretty late. But anyway, you know, we'll catch highlights later.
And people would say, let's skip this match. You know, it's nothing so great. Australia's going to come out trumps. It was one of the most exciting matches. Prashant, I watched the entire innings.
We feel bad for Afghanistan in that sense. I mean, of course, you
almost a knockout punch.
Yeah, you do. You do feel a little bad, but I mean, amazing cricket on the field, right?
Oh, absolutely. Well, you know, so that's cricket, and what's going to happen on the stock market field, right? That's the question we try and figure out as we begin another session. So let's lay it out for you in terms of what you need to know. So yesterday, the Nifty made a very strong intraday recovery. From the day's lowest point, the recovery was strong. Actually, you know, if you look at it, we managed to eke out a small higher high as compared to day before yesterday, although, you know, the average close was slightly lower. I'll come back to the Nifty in just a bit, but the global setup remains as strong as ever. Right after the FOMC, you know, we basically said that this is a significant shift in terms of what the Fed has said and what the Fed chair, etc., has said. And it marks perhaps the end of the cycle in terms of this hiking cycle we've seen. So that, I think, is the underlying driver behind this rally. The NASDAQ was up about 0.9%. That is what happened last night. So that's a strong gain, right? So we had historic hawks, people who sounded that, well, you know, the Fed needs to do more, etc., who all came out and said there were two gentlemen, Governor Wallace and Logan, who both were hawks, who are hawks, but sounded relatively dovish and neutral in their comments that they made yesterday. Now, bonds, I think, you know, at least last night, 7 basis point sell-off of the US 10-year was largely basis that. So we had the 10-year ended at about 4.57, and, you know, a bit of up and down, but roughly we're down about 50-60 basis points from the 5% levels, a little over 5% levels, and it's happened very quickly. The dollar, largely technical reasons, so nothing really fundamental, but that moved up a little bit, but we're still at about 105.5, the dollar index, that is. The big mover overnight is oil prices, right? Oil sold off 4% to just under 82. We're under 82 levels, and I mean, this is Brent, but if you look at the WTI, I think that is now broken the 200-day moving average as well. So it does look like a pretty bearish setup. All of the war premium, all of the conflict premium, which is about $4 or $5, that is gone now out of oil prices. So we'll see. Lots of opinion out there that what's happening with oil and other commodities, etc., it indicates risk off. It indicates deflationary kind of a situation, but it's too early to tell. You know, but for a large importer from a macro kind of perspective, it certainly does help. There are lots of oil-consuming businesses as well, and, you know, we'll watch out for them. Now, just to come back to the Nifty and circle the levels in, we've got the Nifty, as I said, which managed to eke out a small higher high, despite a lower close that we had. Again, slightly lower close, but it was a very respectable, healthy pullback that we saw from the lowest point of the day. We ended exactly at the 20-day moving average, by the way. The 20-day is 19,406. We ended at 19,406.7. So exactly there. So that becomes then a bit of a pivot. The next resistance is 19,500, roughly 530, which is the 50% retracement. So, and then after that, you got the around 19,700 level. So 500 and then 19,700, which is nothing but the 50% and then the 61.8% retracement of the fall from the all-time high to the lows that we saw the week before last. Supports for the Nifty will come in around the 19,200 level. The move also has been pretty sharp. So, you tend to kind of leave any meaningful supports behind very quickly. So that's what we've done. So around 19,200 is where you should look at supports. Bank Nifty is now trading above its 20-day moving average, which is at 43,554. So hopefully that, again, it's very, very close by, but hopefully we stay above it. Next resistance, again, simple retracements. Come in at 44,200 and then 44,700 levels. And supports for the Nifty Bank come in around 43,200 or so, which is about 1% away. So very near term, sort of close levels is what I'm putting out as supports for both the Nifty and the Bank Nifty. The Gift Nifty will come up on your screen, and I think it's indicating another higher start. It's preferable if the market is actually lower a little bit. It spends a day, 2 days lower and doesn't in a breathless fashion continue to run up. It makes it that much more difficult to chase it higher because, globally, as we've been saying, the fog's kind of clearing. Maybe there will be more fog later down the road, but for now it's looking constructive. And this, as we've been saying, is a seasonally strong part of the year, the end of the year. So maybe things will continue to remain constructive and positive. So up on your screen, 40 points higher at about 19,500 plus this morning. Soni.
Absolutely. I think, the going has been very good for the market, and that is something that can continue. The Gift Nifty is indicating a start well in the green, up about 43 odd points. The big cue this morning for me is crude. What's happening with crude? Crude prices are now at the lowest level since July, and now I think Brent crude has fallen to, okay, it's back above $81 a barrel, but the prices had fallen to less than $80 a barrel as well, which is a positive for the Indian market. So that, for me, is the biggest cue, which is, of course, positive. Also, the S&P 500 and the Dow have had a very long run. The S&P 500 has seen its longest positive run since 2021. The Dow is up for 7 straight days. So we have this stability across global markets, something that can take our markets higher. Domestic institutional investors have been buying. So yesterday as well, DI has bought about 700 crores in the cash markets, and the FI selling has reduced quite a bit. If you look at it, less than 500 crores of selling is what we saw yesterday. The important bit is a 20-day moving average of 19,411, where the Nifty halted yesterday. It paused. Not halted, it paused. And perhaps it could sort of resume its uptrend and conquer that level. So that's an important level to watch on the upside. And, we've had some really strong earnings. The earnings season overall may have been a mixed bag, but in the recent past, we've had very strong earnings, whether it is, names like L&T, SBI from the large caps. In the broader markets, the Alchem yesterday reported a really strong set of numbers. The export growth in the US is robust for Alchem, and it had a strong showing yesterday. So keep an eye out on that. The operational performance has been improving for a lot of non-index large caps, whether it's something like an Apollo Tyres, something like a Cummins reported solid set of margins as well. So I'll be keeping my eye out on many of these names. The implied opening indicating about a 40 points up move. So it looks like the going will be good today.
Well, that's right. So, you rightly pointed out that overnight the cues are positive. You have the dollar index has been fairly benign. You have Brent crude prices as well that are lower. And in fact, it's approaching $80 per barrel. So it goes to show yet again that Brent crude prices have failed at around the $95 per barrel. So that's good news. No worries on the global front. Yesterday, what played out? Well, the Nifty Financial Services Index, that played out weekly expiry. And that could have been one factor at play because both those two indices, there is a bit of an overlap out there. The Nifty Bank and the Nifty Financial Services Index, they made a bit of a move from, around 1 p.m. odd. And then we saw it around 2 p.m. yet again. And 3 p.m., they took that leg up out there. So that could be one factor that play out. But what's working for the bulls? I look at the institutional number as a net institutional number. That's the DI and the FI number. You put it together. And the last 4 sessions, that's been positive. So that's good news. The second factor is the FIs were aggressively net short. In contracts, the absolute net short positioning, well, it's come down from around 1.7 lakh contracts, 7.5 lakh contracts, to sub 1.5 lakh contracts. So there's a fair bit of shorts that have got covered out as well. And that's why the FI long positioning from only around 10%, that's moved to around 20%. Short positioning has come down to around 80%. The technicals are looking up as well. I'll tell you why. Because the Nifty corrected close to around 1,000 points, in that move from the 17th of October all the way to October 26th. And, then, in fact, we have seen a 50% retracement. That's a technical positive that 50% of those losses have been conquered. So good news. Nifty Bank, fourth straight session we're ending in the green. Everyone's talking about the US markets being on an unbeaten streak. Well, the Nifty Bank that's been a relative underperformer, that's coming back in style. And it's conquered the 20 as well as the 200 DMA. So on the technical front, well, that as well is looking pretty good. What are the levels to track? Well, the resistance for the Nifty comes in around 19,500, 19,550. And there are more reasons than one to say out there because, that's the low that we made post the breakout of the Israel conflict at around 19,480. While you also have the 50 DMA that comes in that vicinity of around 19,560. So crucial resistance out there. The support level becomes the recent resistance at around 19,250. On the Nifty Bank, I'm looking at support at around 43,460. That's because the 43,600 put was getting written yesterday. So that gives you the support. Well, resistance comes in at around that 44,000 odd mark. The GIFT Nifty suggesting a bit of a green start. I think you wait to buy the intraday dip yet again. And then, in fact, you look for the 19,500, 19,550 zone. That could be a bit of a resistance point. Let's see whether or not we can break out of there.
Okay, so big moves coming in this morning, 40 points higher on the GIFT Nifty at the moment, and lots of positives in the market, lots of individual stocks as well. So let's get straight down to it. By the way, keep an eye out on the Nifty Bank. The Nifty Bank is also coming back in the last couple of days. Yesterday was a good day for the Nifty Bank, so let's see whether we can build on to that gains today. But on the equities front, first up, we have Michael J. Wilson of Morgan Stanley, who says that over the past 2 months, both the US earnings revisions breadth and performance breadth have deteriorated significantly. He says until those factors reverse in a durable manner, he finds it difficult to get more excited about a year-end rally at the index level. Instead, he says they maintain their recommendations for a barbell of a defensive growth and late cycle cyclicals.
Well, that's interesting. He actually, in that note, calls it a bit of a characterizes it as a bear market rally, but more on that later. Let's get you some money market views as well. Now, this is coming through from Kunal Sodani of Shin & Bank, who says that disappointing industrial production in Germany stokes recessionary fears, contributing to euro's decline and in turn dollar index moving higher. He says Brent crude prices have cooled off sharply, which remains rupee positive. He adds the 10-year US Treasury yield remains volatile. For the USD INR, he says 83.1 to a dollar acts as a support, while 83.29 is the resistance.
All right. On the bond market, Abhishek Goenka of IFA Global says the banking system liquidity is back to a modest surplus from a significant deficit. He expects the bond yields to correct further given the slight improvement in the global risk sentiment. However, a major focus shall also remain on Powell's speech today for further cues, and he expects the 10-year bond yield to trade between 7.25 to 7.31%.
Well, we've got a lot of stock-specific action track for you. We get to that in just a bit in our special Top 10 segment. But for the time being, we run you through the list. We're looking at Hindalco, Power Grid, Shree Cement, Cummins, Apollo Tyres, IRCTC, Deepak Nitrate, Vinati Organics, JB Chemicals, and Balrampur Chini. All of them on the back of positive news flow. And for today, in our top 10 segment, we don't have any stocks that will be reacting to negative news flow. So let's see how this goes.
All right. So that's basically the stock list coming up in just a bit. Rajat Bhattacharya is Senior Investment Strategist at Standard Chartered. He's joining us right now to take some questions. Rajat, good to have you with us here. Thanks very much. The 4% sell-off in oil that we saw last night, is that good news or bad news? What's your sense?
Yeah, any drawdown in oil is good news in this kind of market, right? So oil is the direct link to inflation, and that is what is on the top of the mind for policymakers. It's also good news for India, for instance, right? I would add that the news from the geopolitical front is not over. We need to watch that. Clearly, global leaders do not want an escalation in the conflict in Israel-Gaza, and that is very clear from the last few weeks. And as a result, oil has pared back. But you do have the conflict still brewing there, so we need to watch that one. But to your point, yes, any pullback in oil is good news in the kind of circumstances.
Okay, any pullback in oil is good news. Rajat, welcome to the show. Being an investment strategist, how are you approaching the new calendar year? I mean, 2023 was amazing in all ways, right? For the market, that is. We had a very strong performance. The broader market grew very well in India. Do you think this is a performance that we can replicate in the next calendar year as well? And do you think India will continue to be the preferred pick of most global emerging market watchers?
Yeah, there are two elements there to your question. So the first one is the outlook for 2024. And there we are slightly more cautious because this year, as you say rightly, that the markets have been good, equity markets have been good, but we are heading into this global slowdown. Recession is a tough call to make, but you see, the economy slowing clearly in Europe. They're probably in a recession now, a mild recession though. And US, you saw the job market reports from last week, that continues that trend, downtrend that we've been seeing all through the year. If you extrapolate that downtrend, you'll probably see the US job market actually contracting in the early part of next year, by let's say first quarter of next year. So there is that recession risk overhang in the US. Given that and where bond yields are, it's going to be a tough call for equities to beat bonds in the global scheme of things. Coming to India, it's a different story. It's a structural story, as we've been maintaining. So India is underinvested. That's the first point I'll make in global portfolios. If we talk to our clients around our markets here, and they are by and large underinvested in India. It's a story that is just emerging. People are waking up to it, and that's true for both equities and bonds, by the way. The bond, index inclusion is a key one. So India has, further upside. It's less correlated with other markets. So, yeah, the structural story in India remains intact. Cyclically, I think a more broad-based, diversified portfolio with equal weight towards equities and bonds makes sense right now.
All right. Hi, Rajat. So you're sounding a little bit cautious on global equities, and you, I think, tilt towards bonds rather than equities. But from the equity pack, India is standing out, right? That's the point you're trying to make.
Correct.
And within India, what would you bet on? You have the banking space where earnings have been good, autos, the earnings have been good, and the broader markets as well, things have looked very, very good. Do you see incremental money flowing to these sectors or maybe the broader markets as well? Because that's where the big money is being made.
Yes, India is a growth story. So the growth-oriented sectors should continue to do well structurally. I mean, the investment case, the private investment that has picked up over the last decade, let's say, is a big story and a big driver of what's going on in the Indian structural story. So going forward, of course, you have that big election coming up and that political uncertainty comes through as well. But if this private investment pickup, which is backed by government investment has been the trigger, of course, for these private investments, then the growth sectors should do well. Cyclically, though, a more defensive tilt in your portfolios in the very near term should make sense, and that's true for across the board. And to your point about the global markets, year-end rally seasonality is pointing towards a year-end rally, but for the S&P 500, that 4,400 is the key to break. We've seen lower lows and lower highs since July in the S&P 500, if you recall. Sure. So we need to break that 4,400 to see that year-end rally in the very near term.
All right, we will leave it at that. Rajat, thanks a lot for joining in. Appreciate your thoughts. Let's dip into a quick break. On the other side of the break, our list of top 10 stocks is lined up. Stay tuned. Welcome back. I assure you there is plenty to talk about today because there are so many stocks on our radar. So let's get straight to it. First up, we have Hindalco. It was a good set this time.
Well, yes, Novelis came out with a set of numbers, Sonia, and that's the factor that drives the operating profit for Hindalco, and those numbers look good. On a sequential basis, if you look at it, there is a bit of a spike up in terms of volume. So there's a recovery or there of around 5-6%, or you like that. On a year-on-year basis, it's still relatively lower. But the good news is that the destocking of cans, well, that's likely to have taken place, and that's what the management said even in the call. So good news. And that's what brings the adjusted EBITDA per ton. Remember, the last few quarters, it went down to around $376 per ton. The street got very, very nervous. Then they were talking about $500 per ton, but they guided for Q4. So that's come in earlier in the second quarter itself. You like that. And the reason is two of their geographies did very well. North America as well as Europe, which is a larger proportion of sales volume as well as of EBITDA. Both of them saw a good recovery in the EBITDA per ton. You like that? Going ahead, they are saying that, the EBITDA per ton for the Q3 will be in this vicinity of around $450 to $500. But they're saying from Q4 onwards, they say things looking up. Operational efficiency will play out. You have, the spreads as well that are improving. And they're guiding for good times ahead from there on. The debt number stays more or less constant. So you like these set of numbers, expect the stock to open up in the green. But Vivek is joining us to tell us about Power Grid. Vivek?
Well, good morning. A very steady set of numbers from Power Grid this time around. Muted top line growth, but largely along expected lines. So revenues higher by just around 1%, coming in over the 11,260 crore mark. EBITDA higher by 5%, and this, so it has come in at close to 9,908 crores. Margins aided by lower transmission expenses. So margins have expanded over 250 basis points on a year-on-year basis. Higher other income, lower transmission charges have aided the PAT. So PAT has come up almost 4% higher on a year-on-year basis, coming in close to the 3,780 crore mark. Now, transmission revenues this time around largely flat, 10,990 crore versus 10,920 crore. Slight positive surprise. Consultancy revenues were expected to dip, but on a year-on-year basis, it has seen a slight up move.
Okay, all right, Vivek, thanks a lot for that. I'll take it yet again because I'm looking at Shree Cement, and those numbers looked in line to mildly better than what the sheet was working with. Two big numbers, look at the revenue and look at the EBITDA, the absolute numbers. In line, revenue was a little bit better. And on revenues, if you look at it on a year-on-year basis, well, you have a growth of close to around 21%. But you need to keep in mind that the volume growth was only around 10%. That doesn't mean that realizations went up by such a large deal. You have a component of power revenues in there. So we'll have to find out how much of that was there to actually find out how much did the realization improve in the past quarter. The calculated EBITDA per ton, no worries out there. Second quarter running, it's up above that 1,000 rupee mark, another around 1,060. You like that number, and it's on a very, very low base. So that looked good. The profit number, well, that jumped up because effective tax rate was relatively low. So that's why it appeared that the PAT number was much better. And the cash flows as well have improved at around 1,800 crores odd. Give and take everything, they have expansion coming on stream. Well, you like what you see in terms of these numbers. So expect the stock to open up in the green. And we wanted some more details. For that, we'll be getting the management at around 9:30 a.m. later today. Mr. Bangur will be joining in to help us out with some of those finer details.
All right. Well, let's hop across to Upasana now. She's going to talk about Cummins and the Q2 numbers and how it shaped up this time. Upasana, over to you.
Well, it was clearly a margin beat, and EBITDA margins expanded by almost 290 basis points and stood at somewhere around 17.8% versus the poll of 15.3%. While coming to the revenues were down below our polar estimates, so somewhere around 2,000 crores, and it came in at 1,899 crore with a downtick of almost 2.7%, while lower domestic and export sales led to the fall in revenue growth. Well, domestic sales were down 2% on YoY basis, and they were down by almost 19% on quarter-on-quarter basis. Export sales were down about 4% on YoY basis and up almost 2% on quarter-on-quarter basis. PAT was up almost 30%, and it stood at somewhere around 328 crores, which was above our poll number of 288 crores. Well, rise in other income and fall in material cost aided the PAT growth. Well, coming to the outlook shared by the company says that the prior two quarters witnessed a demand shift as both CPCB2 and CPCB4 Plus products are allowed to be sold till June 2024. And the company expects the demand to normalize and sustain for the rest of the year. It is also optimistic about the prospects of continued profitable growth going forward.
Pasna, thanks a lot for that. Let's move on and talk about Apollo Tyres because, it was a good set of numbers. The top line growth has been in a single digit for a while and that continued this time around as well. But the real kicker came in the operational performance for Apollo Tyres. The margins, just look at that, 18.5% margins compared to 12% same time last year. Big up move in the core EBITDA as well. That's because crude prices had fallen, rubber prices had fallen, and that aided the company's margins. If you look at both their businesses, which is the geography-wise, right? The Asia-Pacific and Middle East region is one, and Europe is the other one. It's the Asia-Pacific region which has done very well. Just look at the move there. Revenues have gone from 4,280 crores to almost 4,500 crores, and big move in EBIT also for the company. Actually, that's the other way around. The EBIT went from 200 crores to about 670 odd crores. The Europe region, though, has been in low single digits. So revenue growth of 3% and the EBIT largely flat for the Europe region. But it's the Asia-Pacific region which has done very well. So I'm going with green over there. But let's go across to Mangalam. He's tracking IRCTC. Mangalam, how did it look?
IRCTC overall was a good set of numbers, but the numbers were led by their other verticals and not their ticketing vertical. Ticketing business was slightly soft. So let's run you through the numbers. Revenues grew by around 23.5%. The EBITDA grew by about 20%. Margins were largely stable around that 37% mark. And we saw the company report a net profit growth of almost 30-odd%. The mainstay of the company's operational performance is ticketing. Out there, the revenue and the operational performance, the EBIT grew by just around 9-odd%. So that was stable and soft. But the other segments, catering, picked up. There was just a revenue growth of 29%, but an EBIT growth of 110% out there. And while the water business saw a revenue growth of just 4%, the EBIT growth out there was also 80%. The company reported sharp turnaround in their state Tirtha business as well as losses in the tourism business reduced. So suffice to say that there could be some green on IRCTC today despite the soft ticketing revenue business, because now the third quarter there would be some more contribution coming in from ticketing while these businesses have turned around already.
All right, Mangalam, thanks very much for that. Well, let's focus on chemicals, right? I mean, generally it's not been a great time for chemical sort of earnings, but the debate is on whether things are bottoming out or not. Deepak Nitrite, Vinity Organics are the two we're focusing on. Sonal has got details. Sonal, hi, morning.
Good morning, Prashant. Well, for these two, definitely there's some sequential recovery, and that could mean that, yes, prices are improving, or maybe it's coming on the back of volumes as well. For Deepak Nitrite, it was a good set, both on a YY and on a quarter-on-quarter basis. Revenues were down 10%. However, it was higher EBITDA, up 12%. Margins came in at 17% versus 13.8%, leading to a profit growth of 17% as well. Even on a quarter-on-quarter basis, it was a good growth. Revenues, while they were flat, EBITDA was up 44%. Margins were higher by 500 basis points, leading to a profit growth of 37%. So going with green on Deepak Nitrite, this was led by their phenolics division. For Vinity Organics, yes, YOY continues to be a decline for this one. Revenue down 21%, EBITDA down 25%, margins down 200 basis points. Profits were down 27% as well. But on a sequential basis here as well, there's slight recovery, which the street might like. Revenues up 4%, EBITDA 1.5%, and profits also up 1%. And this trend is largely seen in commodity chemical companies, the likes of Vinity Organics, as Deepak Nitrite, Epigral yesterday, and some of the chemicals for Aarti Industries as well. So this is a trend that we are seeing in this quarter.
Okay, thanks a lot for that, Sonal. Well, let's go across to Ekta. She's here to tell us about JB Pharma's Q2 numbers. Ekta?
Well, yes, JB Pharma is the one that we're talking about. Revenue up around 9% on a year-on-year basis. Margins have done better, 27.6% versus 22.8%. And profit up around 33%. Q-on-Q also, the margins have expanded. Domestic formulations, which is basically the bread and butter of JB Pharma, they have a lot of big brands within that, was up around 11% year-on-year. International business was up around 7% year-on-year. CDMO, which is basically lozenges, they did around over 100 and around 115 odd crores. So they maintained that revenue run rate of over 100 crores within that business. And the first half FY24 net debt has reduced by 248 odd crores. So all of these are probably going to result in the stock seeing further upside in today's trading session.
All right. Thanks very much for that. Balrampur Chini is the next one we're focusing on. Surabhi's got details on this one. Surabhi, over to you.
Balrampur Chini, it was a good set of numbers. The revenue growth of 38%. Gross margins were higher due to better cane crushing and higher recovery. So gross margins expanded nearly 1,000 basis points. EBITDA turned positive this time around at 165 crores versus a loss of 16 crores. And same with PAT, it is a profit of 106 crores versus a loss of 29 crores. Now in the sugar segment, the revenues were up 15%, led by 4% increase in volumes and nearly 6% increase in realizations. In the distillery segment, the revenues were up nearly 2.5 times with a volume increase of over 100%. But the margins were lower in this segment due to higher transfer pricing. But overall, a good set of numbers by Balrampur Chini.
Okay, thanks a lot for that, Surbhi. Well, let's do a quick recap now for top stocks. Stocks with positive news flow. There's Hindalco, Power Grid, Shree Cement, Cummins, Apollo Tyres, IRCTC, Deepak Nitrite, Vinati Organics, JB Chemicals and Balrampur Chini. Well, guess what, guys? There are no stocks on our radar that is likely to open in the red today. So let's take a short break. On the other side of the break, we'll be joined by UBS Securities Emerging Market and India strategist Sunil Tirumalai and the head of India Research and Banks analyst Vishal Goel to discuss Indian sectors and stocks to bet on. Stay tuned.
Okay, welcome back. You've got basically the 30 minutes to go for the pre-open session, and globally, it's a strong kind of picture that we have on our hands. The UBS India conference is also kicking off, and on the sidelines of it, we have the top two people at UBS India joining us now to run us through the house view at UBS. Sunil Tirumala is joining us. He's, of course, India strategist. We have the head of research and also the bank's analyst, Vishal Goyal, joining in as well. Gentlemen, great to have both of you here. Thank you very much for your time. Sunil, if I can start with you, I mean, first of all, congratulations and good luck to the conference as you roll it out, and hope to see lots of people. And it's always interesting, a conference of views and opinion, etc., that gets exchanged at a forum like this. But tell us, Sunil, how is the setup looking for markets? Can we expect a rally into the end of the year in India and globally as well, especially after what happened with the Fed last week? So there was a distinct shift, and the base case now seems to be, at least with mainstream economists, that the Fed is done. The hiking cycle is done. Go on.
Yes. Thank you, Prashant, and good morning to all the viewers. Yes, I think if you look at globally what's happening, our UBS house view is for a mild recession in the US into 2024. It's not a very deep recession, but we are definitely below consensus in terms of what our economic outlook in the US is. And I think along with that, we have again a reasonably anti-consensus call for a drop in a reduction by the Fed and the Fed funds rate, right? And that's I think the global backdrop. Of course, this year has been fairly volatile, and the U.S. economy has shown fairly robust strength signals. And I think that's been a narrative for the last 3 to 6 months in terms of a higher for longer rates. And I think there are some softness that's also coming into that narrative. I think in that overall setup where the global demand both from the US and from China are looking a bit weakish, I think a lot of the market movements are basically being driven by the market's views on the Fed, on global liquidity, etc. Right. So I think overall, from a relative perspective, if I put on my emerging market strategist hat, I would say in the context of where valuations are globally, where valuations are here in India, it would be a bit difficult for Indian equities to outperform other emerging markets. So we're actually kind of cautious on Indian equities at the moment from an emerging markets context.
Well, that's interesting. All right. So you're cautious on the Indian equity space from an emerging market context. Got it. Vishal, I want you to come in on this, because at the end of the day, every bull market is based on fundamentals and earnings growth, right? How have you looked at earnings season so far? Has it been more hits than misses? And what is your expectation in terms of earnings growth for the full year now?
Yeah, so I think while Sunil will be able to help with more details, I think generally we have seen a downward revision in earnings, especially sectors like financials and even IT. So that is where the earning momentum is generally been negative, or we have seen cuts. In terms of earning expectations, Sunil.
Thank you. Yes. Thanks, Vishal. So I think as Vishal was saying, even this quarter earnings season, we have seen cuts across across sectors. The heavyweight sectors like financials and IT have of course been a bit weakish. I think if you look at commentary from companies as well, I mean, after kind of weak monsoons, we were looking up to see what kind of impact is that having on rural demand, on demand from bottom of the income pyramid, etc. We are still getting mixed signals on that. So I think going into the next year and the year after, consensus is expecting about 14-15% earnings growth. We probably, see some, 3 to 4% downside to those numbers. Is how I would, kind of put it.
All right. Hi, good morning, Sunil, as well as Vishal, and wishing you all the best for the conference. I'm sure there'll be a lot of investor interest out there. Sunil, I want to take a point that you just made about a little bit cautious on Indian markets from the emerging basket. Do you believe that other emerging markets are now looking attractive at these price and valuation points?
That's correct. I mean, let me give you both the fundamental and the valuations perspective to that. If you look at, for a foreign investor, you're looking at earnings and returns in dollar terms. If I take a 4 to 5 year history and the next 2 to 3 years of forecast on consensus of actual EPS growth delivered by each of the markets, the stocks and the indices, India is pretty much in the middle of the pack, right? I mean, it's not really been superlative. So the Indian economy may be one of the fastest growing, but not the Indian stocks in terms of the growth that they are delivering on earnings. But if I look at valuations, India has outperformed significantly. And if I look beyond fundamentals and just what we quantitatively call as the perception of the sentiment score that drives valuations, any random emerging market stock that is plugged today and placed in India, listed in India, is getting a straight 80% increase in valuations, right? That used to be 30% premium pre-pandemic, but because of the pandemic-related flows from households and savings coming into the markets, that's really got elevated to a very significant extent. So you basically, if you look outside of India, there is a tech cycle that's recovering. Where we are seeing the inventory cycle beginning to improve. There are, positive linkages of real manufacturing relocation hitting numbers in markets like Mexico, in ASEAN, etc. In China as well, the companies have actually delivered really good numbers. It's just that the market has sold off, right? But basically on a fundamental basis, we're actually seeing reasonable strength even outside of India.
Okay, got it. Sorry, Sunil, on the earnings front, you said based on what we've seen, earnings cuts, right? Both Vishal and you said, earnings need to be adjusted by how much? I think you put out a number. I missed that, sorry. 3 to 4% lower.
So consensus is guiding, is expecting about 14 to 15% earnings growth into next couple of years. I think that CAGR number is probably needs to be shaved by about 3 to 4%.
I see. Okay, got it. Vishal, across your coverage universe in India, how many buys do you have and how many sells do you have now?
So I think generally the mix, for example, again, financials, I can tell you from a market cap point of view, it's around 25 to 30% sell within financial, which is on the higher side, I can, tell you over the last couple of years. So we are seeing slight increase in the sell proportion, if that is the question.
Okay. Sunil, you have a broader number across the coverage universe here?
I mean, I think as Vishal said, even that holds true for the other sectors too. We are, increasingly seeing downgrades. I think unless our, conscious of the valuations that have, kind of caught up, relative valuations are expensive. So, over the course of this year, we've seen, for instance, the auto sector has done well, and we've turned a bit cautious in some of the stocks. Some of the consumer names, are also the places where we've increasingly been turning a bit cautious. But yeah, I think I would say over the last 6 months, the number of sells and neutrals is higher, holds is higher than has been rising, and there's been a general downward shift, and I think that's in line with valuations. And the market has done well, and it's time to kind of slowly start turning a bit cautious.
I want to come back to this discussion on financials, Vishal, because I was going through your report and you do see an increasing default risk in retail unsecured loans. And you say that is likely to push up credit losses by about 50 to 200 basis points. There's also a risk of regulatory tightening, which is quite high. So hence you've turned neutral on the sector. But can you just elaborate on that? I mean, this neutral stance is for how long, and what do investors do in such a situation?
Yeah, sure. So see, now to look at the backdrop, for last 3 or 4 years, we are only seeing credit cost decline. And that is on the back of the NPL cycle peaking, and we have seen some lumpy recoveries also in the last few years, which has supported credit costs. Incrementally, when we look at what is the new area which has actually grown in last 5 years, it is unsecured. So unsecured book actually has grown at 27% CAGR for the system, and it's now around 10 to 12% for banks book, and which is the highest we have seen in last 20 years. So that is number one. So the proportion of unsecured itself is higher. Second, we all know that the credit losses in unsecured book is generally higher than the average retail product, just because of the way it is structured. Also, what we noticed, especially looking at the data we've obtained from Credit Bureau, is lending to riskier borrower actually has gone up in the recent few years. So all this actually points to a fact that we would see higher defaults from this particular segment. And so you're right, 50 to 200 basis point is the incremental credit losses we see for this particular segment, and that will push up credit costs which are at historic lows. So we are back to 2004-5 credit costs. You look at for banks in general, you would see 30 bips, 40 bips kind of credit cost which is going on, which was only seen last I can remember is 2004-5. So this is also abnormal. We would see a normalization in credit cost. That's our view, and we feel that consensus is not fully factoring in the normalization cycle of credit cost.
Okay, gentlemen, have a great conference. Thanks a lot for stopping by and speaking to CNBC TV18 ahead of it. We hope to hear from you post the conference as well to get the key takeaways. Let's dip into a quick break. On the other side of the break, we'll have our market to track. Mitesh Thakkar and Sudarshan Sukhani will join in for some technical trades. Do stay tuned in. All right, we're heading into the market openings. Let's get our experts on board. Mitesh Thakkar and Sudarshan Sukhani are joining in this morning. Gentlemen, morning to both of you. Sudarshan, let me begin with you. The market has been on a strong footing, especially, the global cues are quite good. How are you looking at the picture today? Do you think the Nifty could take out that 20-day moving average quite convincingly?
I think so, yes. The answer to your question is the Nifty should take out its resistance levels and move ahead. Now, exactly the contours of that move is not possible to predict. I mean, whether it will go up and then have a dip or just go sideways, then move up, all that is difficult. That's for the market to decide. For the trader, the important part is what is the short-term trend. The short-term trend was up, and after facing some resistance for 2 days, the chances are that we will overcome that resistance and continue higher. So the trade is very simple. Buy on every dip.
Buy on every dip. Okay, got that. Hopefully we get that dip, right? I mean, we're getting that dip. It's not as if it's a runaway kind of a rally. Good morning, gentlemen. Great to have both of you here as always. Mitesh, what about you? What's the setup and how are you seeing things?
Yeah. So, morning, Prashant. I've been advocating that once we cross 19,250, we should head towards 19,450. I think that's the level which we tested yesterday. That range was, visited. Now, the question is whether we'll be seeing a breakout beyond that. If that happens, then I think we are penciling in targets of around 19,650 to begin with, and then in the best case scenario, even 19,850. I'm still not sure that we have started a new trend on the upside, but this looks like a very strong pullback rally, and therefore it could extend further. That chances are definitely there. So we trade with positive bias. Either we buy fresh if somebody wants to take a fresh position. Either we buy once the Nifty spot crosses 19,450, 460 zones, or if you get an intraday dip of about 50, 60 points. So the idea is to buy, just that, you'll have to be tactically looking at options which are available to you. Similarly, on the bank Nifty, I think getting past 43, 400, 450 zone was very important. I think this is heading towards 43,900, and in the best case scenario, 44,300.
About individual stocks, what are we looking at this morning? Sudarshan, what's on your list?
Well, I'll start with the one intraday short. It's Bata. I'm very disappointed. It's always been my favorite stock, and it's done nothing. So Bata is an intraday short with a stop above 1565. Cipla is a buy. After a very decent correction, it's making a trading range and likely to break out. It's a very fairly attractive chart. Buy with a stop under 1195. HCL Tech is a buy. That's a very attractive bullish pattern in the making. Buy with a stop under 1260. And finally, for a positional trader, Britannia was in a trading range for almost 4 months and has now broken out of that. That's a positional trade. Buy Britannia with a stop under 45.60.
Okay, thanks a lot for that, Sudarshan. Mitesh, what about you? Individual stocks?
Yeah. Nigel, good morning. I have more of buy calls today. 3 buys to a sell. Godrej Consumer and Britannia on the FMCG side feature here. So I have a buy on Godrej Consumer with a stop at 1,004 for a target of 1,055. Similarly, Britannia has a buy with a stop below 46.20 for targets of 47.30. And a buy on ICICI Pru Life, which after a good correction seems to be reversing. That's a buy with a stop at 526 for targets of 560. And one sell call. Maruti still looks like giving some kind of a declining move. So that's a sell with a stop at 10,350 for a target of around 10,000.
Okay, all right, let's slip into a quick break. Thanks a lot, gentlemen, for that. When we come back, we'll get you more on the markets. We'll also talk about the big fall that we've seen in crude prices and the positive for our own markets. So do stay tuned in for that.
Welcome back. You're tuned into Open Exchange, and we are coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, we're almost getting into pre-open, so let's get into a couple of derivative strategies. Rajesh Palvia, the VP Technical and Derivative Research at Axis Securities, joins us on the show. Hi, Rajesh. Good morning. Good to see you in. Well, tell us, how do you approach the index as well as individual stocks?
Good morning, Nigel. So, looking at the overall structure for market, we expect that this rally can extend further, and maybe Nifty can scale up to the level of 19,500, 550 zone in the continuation of this pullback. In the previous session, also we have seen from a lower level there was again a strong buying action, and 19,300 acted as a good support area. Even if we look at the derivative data setup, the most of the put writers are aggressive at 19,300 strike. Even we have seen some addition at 19,400 strike also. For Bank Nifty, now the Bank Nifty's managed to give a breakout above its call concentration area of 43,500. So now if Bank Nifty manages to hold above 43,500 level, then possibly another round of short covering we can see in the Bank Nifty, and possibly Bank Nifty can scale up to the level of 44,000 level also. So both indices are looking promising. Buy on dip should be your strategy. To play this up move of Nifty, we are initiating here to buy call option of 19,400 strike at the money call option, which was closed at around 67 rupees. So one can buy this call option for upside target of 120 to 125. One can keep a stop loss of 35. On stocks front, we expect furthermore bullishness is likely to be there in banking space. Federal Bank is looking very promising. Stock now managed to give breakout above 50-day moving average. The kind of long built-up was there in previous session. We believe that Federal Bank can continue furthermore upside. We are projecting target of 155 to 158. One can buy with stop loss of 143. Another stock is from oil and gas sector, that is GAIL, Gas Authority of India Limited. Stock has formed a base at around 120 level, that was at around 100-day moving average, and now stock is showing good traction since last couple of trading session on the buying side. So GAIL one can buy for upside target of 134 to 136, keep stop loss of 121. And the third stock is from defense sector, that is HAL. Very strong buying action in previous session. Long built up was there. Now stock managed to give breakout about 2,000 level. Looking at the overall structure, we expect that HL can continue furthermore upside towards 2,090 to 2,100. One can buy HL with stop loss of 1,980.
Okay, all right. Thanks a lot for that, Rajesh. Have a good day. That's the word coming in from Axis Securities. But let's get down to talking about one of the big cues of the day, which is the fall in Brent crude prices. Manisha Gupta is here with all the action from the commodity markets overnight. Manisha, over to you.
Well, thank you so much for that, Sonia. We're looking at the prices trading at a 3-month lows right now. Overnight, it has been a 4% decline in the crude prices. And when you look at the prices in the previous week, we've seen 6% of a fall coming in. In the month of October, it was a 10% decline for the crude oil prices. So it has been a constant weakness continuing for the crude prices. The latest trigger comes in from the fact that there is a steep rise in the U.S. inventories, as high as 12 million barrels. The other thing is the weak China export data that we saw come in yesterday, and the China inflation numbers come in tomorrow. That is what the street will watch out for. The U.S. consumption for fuel also has continued to decline on a month-on-month basis. That is weighing on. And then with Israel considering tactical pauses in Gaza, also tells you that no other Middle East country is involving. There is no impact on crude supply or exports. So that premium clearly has gone off the markets. It was in the month of October that we saw a high of $91 a barrel also, and we're trading at 81 right now. So $10 has gone in a matter of less than a month in sense of crude prices. The expectation going forward is that if the China demand does not come back, then the kind of deficit that the Russia and Saudi Arabia are trying to create will actually be in par with the demand and supply that the global markets will be looking at. At these levels as well, I'm looking at more sell calls coming in from the global banks and brokerages, with the expectation that the crude prices now could be headed below 80, 78, even 75 is something that some of the banks are putting out.
Thanks a lot for that, Manisha. Well, let's move on then. It's that time of the year yet again. The festive season is here, and we at CNBC-TV18 are doing our best to help you enjoy a prosperous and a profitable Samvat 2080. To help you do that, we invited our audience to interact with one of the country's top fund managers, S. Narain of ICICI Prudential AMC, besides others, and asked him about his strategy, about asset allocation, and his thoughts on the active and passive funds. Let's hear him out.
Passive as a strategy is very big worldwide, right? And in India, it's still gaining momentum. People are still trying to adjust to index funds and kind of just learning about them. I wanted to ask, what would be a good strategy? Would it be passives, only actives, or a mix of passive and active both in your portfolio?
Okay, I'll ask the panel. Interesting question for sure. And I think we got these queries during the course of the year as well, because a lot of fund houses have started now launching mutual funds which mirror the index itself, the mid-cap index or the small-cap index. So basically passives on even mid and small caps. Naren, what's your take on this trend and what would your advice be?
If you look today at anything other than mid-cap, you'll find that actually huge alpha has been created over the last 1 year, 3 years, even 5 years at this point of time. In mid-cap, it's quite a different experience. Mid-cap funds have done very badly against benchmarks. So passive has done very well. So you go through these phases. If you had looked at 2018 end or 2019, passive had beaten active very, very much in most of the large cap funds. So you go through these cycles, but at the same time, on a continuing basis, I think we have a tortoise in the form of passive, and we have to recognize that. And having said that, there will be times,
the race in the
but
end.
you should see today the performance of actives against passives in large cap. You'll find that most of the, no one talks about it today, but most of the large cap funds and most of the flexi cap funds have done so well against the index over the last 1 year, 3 or 5 years by a huge margin. When they underperformed, people kept talking about it. But today, when they have outperformed, no one is talking about it. That is one of the regrets of an active manager like me.
Not at all. That's why we have you here, because we want to hear from you. And, when you put out some of these snippets, I'm sure people will keep it in mind and go back and...
But truly in mid-cap, it's still, at this point of time in mid-cap, passives have beaten active hollow. But in all other categories, actually, on the last 3 years and 5 years, actives have actually done pretty well.
Okay, I love this active-passive debate. It's an evergreen one, and at least in India, it is going to continue to be a vibrant one for many years ahead, right? Okay, so coming back to the classroom, Naren, let's get to your lecture. You are going to teach us a bit more about asset allocation today, right?
Yes.
Okay, so tell us, how should we look at asset allocation? Why is it important? And how should we go about, asset allocation as we get into this new year?
See, 2007, 8, 9 was a red letter period, where, as Nilesh pointed out, the number of investors in India in mutual fund is still very small. So we felt that, this mutual fund industry saw itself as an equity mutual fund industry. And we said that we have to move out of that and move into a situation where we created categories like balanced advantage and multi-asset. Because if the mutual fund industry was not a equity mutual fund industry, actually gold gave very big returns in 2008. And consequently, this whole thing, we started popularizing categories like balanced advantage, and later when scheme categorization came, categories like multi-asset. Because once we did that, we got the real benefit actually in COVID. Because in COVID, actually, equity did badly immediately, but asset classes like gold did well. And we have had a situation where this whole concept of asset allocation, where you invest in equity, debt, and gold, actually leads you to a very good experience compared to just investing in equity. And the problem that Nilesh pointed out, that investors are much more invested in other things and not in mutual fund, can be corrected only in that way. Because the day you make it an equity mutual fund industry, you cannot make the industry as large. Look at the scale of all the other industries, they've been much bigger. So that's what we felt, and the experience of 2018 to 22, as the data would show, there are years in which equity has done well, there are years in which gold has done well, and then the investor experience is much better, and then you can scale up the industry. And today, all of us in the industry have launched multi-asset funds, primarily because we have realized that that is one way of increasing the number of investors in the industry and ensuring that the investor experience can also be much better over the next 3 years, 5 years, 10 years.
Okay, absolutely. And I guess as that data was showing, it's very volatile, these three asset classes. When one does well, the other is usually languishing. So maybe a mixed approach works. And it's also tax friendly, right? I mean, the multi-asset funds have the tax advantage.
That is less important than the fact that, in a year like 2020 or a year like 2008, it is gold which gives you the return. And in other years, it is equity which gives you the return. So it kinds of, because finally at the end of the day, the return that you get in other asset classes is low. But this balancing influence actually moderates the investor experience, but gives an investor a much better experience.
All right, well, that's a Diwali masterclass, and you can catch that episode through the course of the next many days. But let's get back to the market, because we are going to open in, I think, less than about 10 minutes from now. Sudarshan Sukhani is joining in. Sudarshan, the market indications are that we would see a little bit of a downtick, especially in some of the banking names. What would your big call be at 9:10 this morning?
That would be to buy HCL Tech with a stop under 1260.
And Mitesh, what about you?
Yeah. I recommend buying Godrej Consumer with a stop at 1004, targets of 1060 on the upside.
Okay, all right. Thanks a lot for that, gentlemen. Well, let's get you the top stocks we're looking at. Ekta joins us to tell us about Alkem Labs, because there's a shift in their guidance out there. Ekta?
Thanks for that. Well, you know, the big surprise for Alkem during market hours when they reported their numbers yesterday was that the margins improved all the way to around 21.7%, which was a 5-quarter high for Alkem. So now the conference call, which was held post-markets, they have indicated two things. First is on India, where they've retained their guidance of high single-digit growth guide for India in FY24. In Q2, growth was around 5% on a high base for India. Separately, they've marginally raised their guidance in terms of margins to 16.5% for FY24 versus 16% earlier. So the street probably likes that, and maybe there could be some amount of second half volatility, because remember that the first half margins currently stand at around 18%. Now Nomura has written on Alkem, they've upgraded the stock to buy, target at around 4,963 rupees. Q2 is ahead of estimates. Earnings are supported by factors such as lower cost as well as tax rate. Macquarie underperformed call, target price of 3,175. According to them, Q4 profitability is expected to remain weak due to adverse seasonality. But net-net, the street is expecting a better operational performance as per the guidance from the management. We could probably see the stock higher on account of that.
Thanks a lot for that, Ekta. I'm looking at Hindalco because Novelis came out with this set of numbers, and those numbers look good, and that explains why Hindalco is one of the top gainers on the Nifty as we speak, or is the top gainer. Now, on the volumes front, there's a recovery on a sequential basis, so you like that. On a year-on-year basis, well, it is expected to be lower, and that's precisely what happened. They adjusted EBITDA per ton. Remember, a few quarters ago, it went to sub $400 per ton, and that's when the street got a little bit nervous. They guided that in Q4, you'll have the EBITDA per ton moving to around $500 per ton, but they've done it earlier than expected. So the street will like that as well. Better volumes on a sequential basis. You're going to have better spreads out there, and operational efficiency is what aided them. And two geographies did particularly well, North America as well as Europe. The commentary as well has been positive because they say that that entire destocking exercise of the can, well, that's already taken place, and that's what will help volumes going ahead. Now, in terms of guidance for Q3, they're saying, yes, the EBITDA per ton will come back down to around that $450 to $500 per ton. But from Q4 onwards, they're talking about $525 per ton, and the street will like that. The capex as well, you know, they have done a little less than $1 billion approximately. It's likely to be at the lower end. And for the time being, the net debt number is holding pat, you know, on a sequential basis. Brokerages, a couple of them are quite impressed. You have Jefferies that has a buy rating. Equeris, they've maintained an ad rating. They've tweaked their estimates. And Nuvoma, though they have a hold rating, well, they as well have increased their consolidated EBITDA estimates by around 7 to around 1%. So that's about Hindalco.
Okay, and I'm also looking at Eicher Motors. For all you bike enthusiasts, the Royal Enfield brand has unveiled their Himalayan electric test bike. It's just a prototype. It's called HIM-E, and this was unveiled at the EICMA 2023. And, you know, this is a pure electric prototype. They've launched this prototype so that they can eventually start production on their EV bike and, you know, their next-gen electric powertrains. But they've also had another unveiling. They unveiled the new Himalayan 450cc, and the launch will be on the 24th of November 2023. So that is, of course, an ICE bike. If you look at it, you know, the growth for Royal Enfield has been in low single digits. In October, Royal Enfield sales went up just 3%. But if you map the year up until now, it's been a double-digit growth. So we've had 13% growth in year-to-date in Royal Enfield sales. But let's see if any of these new launches help them in terms of a monthly run rate or not. So I'm going with green on Eicher Motors this morning. The other thing to focus on is Indigo. So, you know, I just wanted to put it on board that in case you're wondering why the Indigo stock is under pressure, The company says they expect the grounding of 35 aircrafts in Q4 due to the Pratt & Whitney engine issue. We know this because, they had mentioned in their conference call as well. They said they expect 30 to 35 more aircrafts on ground by March of 2024. This would take the total tally of planes out of service to nearly 75. And the airline is saying that it is taking steps to mitigate all kinds of capacity constraints at the moment. They will have over 70 aircrafts on ground by March of 2024. That's why, despite the fall in crude, Interglobe Aviation is still under pressure because of this grounding issue.
Okay, I mean, oil's down 4% and Indigo is down. So that's the news which is playing on the minds of investors. We got, what, 2 minutes to go to open. Let's use 1 minute out of the 2. Mitesh is with us. Mitesh, quick, rapid fire. BSC, more to go here?
It does look like that, Prashant. I think the medium-term charts are very good, and I have penciled in targets of around 2350, 2400 over here. That's, a positional kind of a call. The only thing is that from a reading point of view, don't buy now. Wait for a decline to about 1900 levels to enter.
Trend saw a very large move. There are strong earnings upgrades as well, but maybe those earnings upgrades are already in the price. But go on, Trend.
Again, very similar situation, no signs of weakness, and I think this has started a fresh round of expansion. So 2700, 2750 on an extended basis should be the target area. Having said that, again, I think the entry point should be slightly lower. On a bad day, you want to buy this.
Okay. All right, I think we just have a minute to go before the market opens. So let's just get the rates on board. Looks like it's going to be a decent opening. The pre-opening session has ended with a gain of around 42 odd points. And a lot of stocks in focus this morning because of the crack that we've seen in crude. Perhaps you could see a lot of these paint companies move up. Aviation companies, Indigo has its own issues. But apart from that, tire companies have been doing well because of the fall that we've seen in crude. So keep an eye out on that. We had good numbers from pharma companies. So stocks in focus would be Alkem, but the company has raised their EBITDA guidance for the full year and they saw very strong export growth as well. So Alkem is up about 0.6%. Apollo Tyres, Cummins were a couple of other names where there's been a margin beat this time around. Deepak Nitrite, IRCTC, also a couple of other names which have looked good this time. Good growth in margins. In fact, Deepak Nitrite, I think, is up 4% in pre-opening. So that will be one of the stocks in the broader markets to look at very closely. But here's the first take on the index. It's not bad. The Nifty is at that 19,450 mark, up almost about 40 odd points, 32 points actually to be precise. Sensex also in the green at the moment. Let's take a look at the top movers. The Nifty Bank is flat with a bit of a positive bias. There's a little bit of an underperformance there, but the mid-cap index is doing pretty well, up almost about 0.5%. As I said, because of the fall that we've seen in crude prices, you've had paint companies do well. HPCL is up in the green at the moment. Some of these NBFCs like Bajaj Finserv are also trending in the green right now. Grasim, UPL and IndusInd Bank are a couple of other names that are in the green as we speak. Let's take a look at some of the losers. At the moment, you just have Indigo, which is under a bit of pressure from the broader market losers. But apart from that as well, there you have it, down almost about 0.7%. Banks, by the way, are supporting the market this morning, especially PSU banks, PNB, Bank of Baroda, all in the green. SBI has been gaining slow and steady after its numbers, 0.4% higher, while Axis Bank is also in the green right now. HDFC Bank is the only one that's bucking the trend this morning, down about 0.3%. But otherwise, not a bad opening at all. Nifty now holding above that 19,400 mark, so gotten above the 20-day moving average. Important to see if it holds that level today.
Well, that's right, Sonia. But plenty of stocks actually from the broader markets that are moving around. Yatat Hospitals, those numbers look good. That stock has taken off. Prince Pipes, those numbers as well look good out there. Good operational performance is what we said, and the street likes it. So that's another one that's moving around from the broader markets. You have Skipper as well, that's moving up. The numbers look quite good. Stock is up close to around 6% as we speak. So those are about positive earning reactions. On the flip side, Idea Forge, remember when that company listed, we saw a lot of interest out there. It had a blockbuster listing as well. But that one, I think, post its numbers, it's pulled back. And the last time I checked, I think it was down close to around 10%. So Idea Forge should come up for you. Now down close to around 6%. It's corrected big time from the day of listing. You have a couple of other notable movers as well. Mishra Dhatu, Midani. For the last quarter, it's a weak quarter normally. We've seen quarter 4 and as well as quarter 3 when the revenues spike up. But out there, the margins got compressed. So Mishra Dhatu should come up for you on the screen. Midani, that's the stock that we're talking about. That's down as well in trade. And Rain Industries as well is selling off a little bit. So that's about some of the top movers in terms of positive and negative reactions on stocks.
Nigel, so it's a upstart. So 12 points or so is what we have, 19,420 on the index. Just a few other names before we move forward. HPCL, I just want to quickly highlight. That one went up 6% yesterday. It's up another 5%. Last week on Friday during the editors' roundtable, when you had looked at earnings, biggest changes to FY25 earnings estimates over the last 1 month, on my list, at least IOC came up. HPCL, of course, reported after. IOC is already up 10% this week. HP is up now with today's gain 10-12% as well. There is, of course, with HPCL, the lubes business, which they've been talking about kind of divesting it. They, of course, need a lot of approvals, etc. for it, but that is the other one which is at play. I think Deepak Nitrite, we mentioned 2.5 higher. Apollo Tyres is up about 3%. BSE continues to charge up. BSE crossed that 2,000 rupee mark yesterday, big 7-8% move. It's up another 2.5-3%. So this is in the hands of very strong momentum now, BSE. Varun Beverages has seen some earnings upgrades to 24 and 25 numbers. It's up 2.5%. There is Prestige, which is up 4.5%. We will hear from the management coming up in about 30 minutes or so from now. Yatharth, Sonia mentioned, 7.5% higher. Angel One is up about 3%. Prince Pipe has got a 6% move on very strong volumes right now. Newland Laboratories is up 4%, just highlighting things with volumes, not going down the list. And Schneider is another one which is up about 4% or so. On the downside, I saw Idea Forge. Idea Forge was down 7%. It's down 6 now. So there's a, but that's still a sharp cut coming through on Idea Forge. It's anyway not. It's been a bit of a disaster stock price performance-wise since listing. 820 on Idea Forge, and it's got decent-sized volumes for this point in the day. Rain Industries, Mishra Dhatu, that is down about 4%. So it's, Himmat Singh Ka seed is coming up with a 6% cut. But again, you kind of need to wait and look at volumes before sort of taking a call on what this is going to do from here on. But all in all, I think we're up about 7 or 8 points, 19,414. But market breadth is almost 3:1 in favor of advances. Nilesh Shah is a market master today. He's managing director at Kotak Mahindra Asset Management Company. He's with us here in our studios. Nilesh bhai, great to have you with us here. Thank you very much. And looking at you in all your finery, we are feeling serious FOMO.
I definitely am. I'm like, if Nilesh was coming dressed up for Diwali, I should have done the same.
If you had known, 100%. So, but thank you very much for dropping by.
I'm trying to represent the festival season in the market.
Very much needed, and absolutely. Nilesh bhai, how is the market looking? How's the earnings season been? Let's, I put out a piece on Friday which kind of showed that out of the top 200 companies, about 60% of companies actually have seen some downgrades. Nothing large or major, but it's not. It should be the other way around. 60% should see upgrades, but that's not happening as yet. Go on.
So one, Indian market is not like Australian cricket team yesterday when they were down 7 wickets and we need Glenn Maxwell to pull a miracle. We are like our Indian cricket team. We were winning 8-0. Now, what more you can deliver on those expectations? And which is why some marginal adjustments are happening. But frankly speaking, today when we go and meet corporates, small, medium, large, everyone is looking at future with a lot of positivity. Their leverage is low, their turnover is up, the capacity utilization is 75% plus. Everyone is now looking to invest, looking to expand capacity. Frankly speaking, we are living in an era where experience is becoming a liability. We have been hit in the market so many times that you don't want to accept all the good things at face value. And your suspicious nature is pulling you to figure out what is wrong, what is wrong, what is wrong. Kuch to garbar hoga. But actually, it's just working out so nicely.
Okay. Nilesh, first of all, happy Diwali to you, and hope this is another prosperous year for you, your team, your family and everyone involved. More important is health, right? Prosperity health-wise, more than wealth. But I wanted to ask you a little bit about how retail investors should approach the year to come, because there are some headwinds on the horizon, whether you talk about geopolitical issues, whether you talk about what's happening across the globe. Do you think any of that would get to our market or not? You think it's going to be a pretty smooth run from here on?
So you should never say never. But our biggest bugbear was oil. And with geopolitical tension in Middle East, it was expected that it will go into triple digits. Today it is down to around 80s, 85s. Who would have expected that US will lift sanctions on Venezuela? Venezuela has more oil reserve than Saudi. and they are producing probably 5 to 7% of Saudi's oil production. Now, it makes sense for Saudi to keep oil prices under control rather than run away. Straightway, India benefits. So, I'm seeing this kind of, interventions happening, which is removing our challenges. Some time back, we were worried about monsoon because August was dry. In September, rains recovered. Now, it hasn't reached to above average, but from deficiency of double digit, we are in mid-single digit deficiency. So in the market, you should never say never. But truly right now, large caps are at historical valuations. Small caps are at 20% premium. So bearing valuation concern, which one can debate about, I think on growth there is consensus, on corporate health there is consensus. So my recommendation to retail investor, just stay invested. And if at all there is a correction for some unknown event, grab it as an opportunity to build your equity portfolio.
Well, hi Nilesh, good to have you in the studio. And I always tell you I'm following that policy.
SIP.
SIP, I'm keeping it going. And
so, Nigel, now there's one beautiful definition of SIP. Sab ichha ki purti.
Amazing.
Did you come up with that?
No. It's all WhatsApp gyan.
I think Nilesh, you should put the SIP campaign, the Amphi campaign. I think it'll fit nicely.
Lovely. But we are keeping the faith and we're going according to that advice as well. But talking about markets, things are looking good. And as you just mentioned, from the broader markets, maybe the premium has gone up a little bit in comparison to the large cap names. So incremental money, where does it go? Would you put it more towards the large cap names? Because they have actually underperformed in this year so far.
So undoubtedly, there are many underperformers like large caps, private sector banks. But that is why they have become cheaper. In large cap companies, earnings growth momentum has not slowed down.
Right.
In private banking, earnings growth has been fairly good. So we believe right now it is time to focus on valuation. And if you buy below average valuations, the chances of you making money will be far better. Undoubtedly, small and mid caps have done exceptionally well. And many of those companies have delivered also good results. But at this valuation, probably they will need to halt a little bit so that there is a time correction when earnings catch up with the fundamentals. So we are relatively choosy about valuation, trying to invest into, let's say, the bottom half of valuations rather than top half.
Which would get you to, if you were to kind of dissect that, not via large caps, mid caps, but sectorally, it'll get you to a lot of consumer names in that sense, right?
Absolutely.
Not staples, but there are lots of other
consumer
names.
Durables.
Beaten down, bombed out. Is there a place to look for opportunities? Are you seeing things happening there?
So normally we have seen ahead of election, governments puts money in the pockets of consumers. And there is a higher velocity of money due to spending. Now that should generally go to the bottom of pyramid. And they should be looking to spend money rather than save, unlike top of the pyramid. So both consumer staple and durable should have a better volume as well as margin growth in the run up to the elections and after that. And consumer durables have bombed out. They haven't really had a good run for some time. This festival season, there are green shoots visible. In fact, today's headline also talks about green shoots being visible. So our feeling is that it is time to accumulate consumer durable and select consumer staple and play for the election cycle.
Just to extend that point one step further, when you said you meet corporates and industry, they're all very optimistic about the future. But you hear this this feeling that the bottom of the pyramid is still, it's been actually down and out for a while now. Actually never really recovered in a big way post-COVID. So is that, how does that kind of fit in broadly?
So undoubtedly, Prashant, the bottom half of pyramid consumption is stayed, and that's reflected into mass market brands not doing as well as premium brand doing well. We believe this softness has continued for almost 18 months. And now, hopefully, there should be a bottom. Please be aware that we have been wrong for last 12 months, expecting a bottom. The bottom has not yet happened. But we believe this festival season, things could change. The early signs of sellings by e-commerce companies, selling by reduction in discount or full price merchandise getting sold, all are giving hope that this time, hopefully, bottom of the pyramid will participate in festival season as much as the top of the pyramid.
Okay. This earnings season has been interesting, right? It's been a mixed bag, but largely a lot of the nifty heavyweights have done well, whether you look at SBI, L&T, Titan, Bajaj Auto, Maruti, across sectors. What has your preferred space been post-earnings, where you think there is both valuation and growth headroom?
So banking and financial services continue to remain the preferred bet. Their earnings momentum is positive. Of course, it will slow down in the days to come, but valuations have corrected quite sharply. The second broad theme which we have been looking at is capital goods. In the past, capital goods were sustained by the government infrastructure spending. Now we believe it is government plus PSUs plus private sector which will all come together. Now, some investments may get deferred after election, some may happen before election, but we see there is a big runway for capital expenditure to grow, and that should support capital goods company. One cherry on the cake is that many of these capital good companies are also becoming part of the global supply chain management through their parents or otherwise tie-ups. So they will cater to local market as well as global market. So between banking and capital goods, I think we are finding a lot of opportunities.
Banking and capital goods. One more sector I wanted to discuss with you was EVs, because now with so much pollution, I mean, people are really taking concrete steps in sustainable energy, or whether it's renewable energy or even electric vehicles, right? For that matter, people are sitting up and taking notice that, listen, it's affecting you and your health now, so let's take some steps. A lot of companies have been early adopters in this electrification space. Do you continue to bet on them, the likes of Tata Motors, etc., or do you now move outside the index as well?
So within the automobile sector, first is mass market versus premium. If you are at entry level car, you will sell for 5 lakh rupee and make 50,000. But if you are in SUV, you will sell for 25 lakh and make 2.5 lakh rupee. So premium brand over mass market is preferred. The second is that the future is EV stroke hybrid stroke hydrogen, or maybe some other technology which we don't know about. Now, every company is trying to move into that space, and we'll have to really bet upon those companies which are going to be ahead of their peers. In two-wheeler electrics, we have seen some successes, many failures. In automobile, we are seeing different route being taken by different companies. Some are focusing on hybrid, some are focusing on EV, and who knows, someone may focus on hydrogen. So we'll have to really see how these technologies evolve. Today, jury is not yet out on whether EV is environmental friendly or not, because if your power is going to come from thermal side, you will shift pollution from cities to villages or to the coal mines. So we'll have to really see which company goes and invest into futures. In a very crude language, बचपन में जब हम लोग जाते थे एसटी स्टैंड के ऊपर, तो हम रुमाल रखते थे, जो बस जाएगी वहाँ पे बैठ जाएंगे. As a fund manager, we are also replicating the same. रुमाल रख रहे हैं. Depending upon how those companies actually perform in the future, will be increasing our positions.
Okay. All right, Nilesh, always good hearing your thoughts. Thanks so much for coming down. And since we started off with cricket, I'm only worried that yesterday Australia made such a good comeback. I hope they don't get that momentum going for them. But do you think this cup is ours?
So undoubtedly it is ours. Glenn Maxwell inning was fantastic, no doubt about it. But I just hope and pray it doesn't become like Kapil Dev's inning for Australia.
Indeed, fire up.
One inning, now you have done, you should rest.
Good his innings was with Afghanistan, right?
Absolutely.
Right.
Now we should rest.
Thanks, Nilesh. So hopefully the next time we chat, maybe the markets trend higher beyond the 20,000 odd mark, and India as well will be lifting the cup, and we'll be saying Chakte India.
Amen.
All right. Thanks so much.
Thank
Well, let's move on then. Let's get another corporate on the show. We have Mr. Bangur, the chairman and Shree Cement, who joins us on the show. Hi, Mr. Bangur. Good morning, and thanks so much for joining in. Well, your numbers looked pretty good, but I wanted a couple of details. When you give your sales number now, you don't break up the power segment, which is a smaller part of the business. Could you tell us how much did power contribute to the top line? Point number one. And how much of change was there in realizations, in the past quarter?
Our power sale is about 325 crore, to be exact 324 crore.
Okay.
And EBITDA in power will be around 8 to 9%. Ours is a high cost unit, 100% imported fuel. So only when the power is really high, we sell it. So our EBITDA on power is on average 8 to 9%.
Okay, all right. So what was the realization change then for the past quarter? If you could give us, a sense on that, and how much is it likely to go up by in quarter 3? And also for volumes, earlier you were talking about outgrowing the market. So what should the volume growth look like for FY24 on prices as well as on volumes? Please go ahead, sir.
So first of all, volume will be increasing by about 12% in the whole year. First half it is higher by 14%, 13 to 14% in the first half. The second half will be little lower. So overall, the volume growth will be minimum 12%. It can be a little higher.
Okay.
That is one part.
Sure.
Realizations.
The realization this year compared to last year and last quarter is higher by 1 to 2%. In October month, compared to the July-September quarter average, our realization is higher by roughly 200 rupees a ton on an all-India basis. Somewhere it can be little higher, somewhere it is little lower. Overall, 150 to 250 we can say.
Okay. 150 to 250, got it. Mr. Bangur, good morning and thanks for joining in, and greetings of the festive season to you and your entire team at Shree Cement. Just want to understand a little bit about the demand trends. What are the demand trends looking like now as we head into election season as well? And where are you seeing the maximum amount of demand coming from?
Demand is, why I was saying that the second half will be lower, because our capacity will be full. Last month also, we dispatched 31 lakh tons, 1 lakh ton per month, per day on an average. And
Oops, okay, I think we have some issue with that video. We'll just go back to Mr. Bangur in a bit, talking about how the capacity at Shree Cement is full. So, of course, demand is very strong, but they're looking to raise their capacity as well. Overall volume growth will be higher than 12% is the comment that he made. Just before he gets back on board, wanted to take a quick check on what's happening with the market. The indices are all in the green. The mid-cap index is actually up 0.7%, so looking pretty strong there. The small-cap index is also well in the green at the moment, and lots of individual stocks are having a strong run. The entire tire space, the paint space, all looking very good this morning because of the fall that we've seen in crude prices. So Apollo Tyres, Berger Paints, Asian Paints, Kansai Nerolac, all in the green at the moment. Of course, look at that. Apollo Tyres, very strong numbers. The operational performance has been solid, but the other stocks are also moving in the direction of, the green side. So Asian Paints, etc., Berger, all in the green at the moment. So that is one space because of the fall that we've seen in crude prices is looking pretty good. But we'll try and establish a connection with Mr. Bangur yet again. Mr. Bangur, if my voice is reaching you, I was asking you about your demand trends and you were telling me that capacity is a constraint right now. So what will your capacity be after the expansion post, say, FY25? How much are you looking to rise it to, sir? And, once the capacity, fresh capacity comes on stream, what kind of growth are you factoring in?
Our capacity at present is 50 million ton. By the end of this year, financial year 24, it is expected to be 56, or it will be 56 as the projects are almost being completed. Next year, it is about 62. So in the next 2 years, 12 million ton of capacity is being added.
Okay, so you're saying 12 million tons of capacity will be added in the next 2 years. What would that do to your, once it comes on stream, right? I'm sure you're expecting a growth on the top line as well as on the EBITDA per ton. Currently, I understand that you have around 1,000 rupees per ton, 1,060 thereabouts per ton. How much can you add on to that incrementally over the next 2 years?
Regarding EBITDA, I really never comment because it is a factor of cost as well as the sales price. And nobody knows the sales price can predict the sales price. So EBITDA is too much to comment. But generally the demand will be good. EBITDA will be expected to be higher from here. I will not like to give it a number.
Oh, but that's good enough for us. EBITDA will be higher from here. That's good news. And just to clarify, sir, realizations as of October average are 150 to 200 rupees better than the average of quarter 2?
The last quarter, July-September quarter.
Got it. Okay. A couple of more questions. Now, premium products as a percentage, I recall, we had a chat at your Rajasthan unit as well, and you said there will be a focus out there, but you're looking to increase the contribution of premium products. You have done that. Where do you see it end at the end of this year as a percentage of your trade sales?
Right now, it is around 9.5%.
Yes.
By the last month, it will be around 10.5%. We are growing gradually because in the premium products, we don't want to dilute the price. So the volumes will come naturally. We are only focusing on the right quality, right price. Volumes the market will give us maybe a little late.
Okay.
Our focus is on the right price.
Got it. So by the end of this year, it will go to around 10.5%, so 100 basis points higher than what it was.
Right.
Okay. You have told us about your capacity going up, Mr. Bangur. But, you got Mr. Neeraj on board as well, and maybe there would be some focus on inorganic growth. Have you heard about any asset being on the block as of now? And are you interested? In the past, there have been various, reports that suggested that Shree Cement is looking at inorganic growth. But nothing really has been closed out in the recent past.
No, Shree Cement is not looking at inorganic growth. From
not at all, sir?
50, not at all. Unless it is really good. So normally we will like to concentrate on our own working. From 50 to 80 we have to reach in 4 years. So 62 in 2 years. Then we will like to reach up to 80 or so in 2 to 3 years further.
And all of that will be organic?
All of it will be organic.
All right, just one more question, sir. If you're not looking, but some of these companies that would like to sell, they would approach a big name like you, right? Shree Cement. So have you seen any of these assets on the block? There are various rumors that there's a company in South India, in the West, even in the North. Any large size deal? Yeah.
Some proposals have come. It will not be fair to name any of them. Only thing I can say is that we will not be looking at any of them at present.
Okay, so not looking at any, unequivocally saying that you're not looking at any inorganic acquisition at the moment. Got it. We take that point on board. I just had one question. You said that there's a 12% growth in volumes that you're looking at for FY24, but in the next 2 years, you have 12 million tons capacity that will be added. So could you replicate this 12-13% growth even in FY25, or is it a possibility that you could do better than that?
When I say minimum, I say minimum. So, of course, it can be better than that, but 12% is the growth will be the minimum growth, I am saying.
Okay, for FY25 as well, right? That's a fair assumption.
Yes, this is a fair assumption.
All right.
All right, just one more point, sir. There was that IT survey that made investors very, very nervous. Any outcome out there?
Till now, no progress is there. The things are lying where it was in the last quarter.
Okay, all right, Mr. Bangur, always a pleasure talking to you. Thanks so much for joining us here on CNBC-TV18. You're telling us the EBITDA per ton will look better from here on, and volume growth at least of around 12%. Also clarifying that you're not looking at inorganic growth as of now. There could be select assets that could be probably on the block. For the time being, we slip into a short break. You come back, we'll focus on Prestige Estates. The management join us to tell us about the past quarter's numbers.
Welcome back to Bazaar. Well, let's focus on Prestige now. The company reported a good set of Q2 numbers. The Q2 pre-sales doubled and the sales volume zoomed by 50%. In fact, the company registered record-breaking highest sales in the first half of FY24. So let's get just a sense of which way things are headed. Of course, we have the management, Irfan Razak, the chairman and managing director at Prestige Group. Mr. Razak, good morning and greetings of the season to you and your team. I know we spoke just a while back about your operational updates as well, but now that the first half is behind us, just wanted to understand what will FY25 look like? We have a fair idea of which way FY24 is expected to go, but what are the numbers looking like in FY25, and what is the pipeline?
We're going straight away to FY25.
Yeah.
I think let's end FY24 first. Like I said, we are looking, the next 6 months is also very, very strong. We have a lot of launches planned for this next 6 months in all the cities that we are present in. And that will actually boost our numbers. And like I previously said, we are targeting a number of 20,000 top line on pre-sales. And I think the teams are working hard towards it. Now, what does FY25 look like? That's actually a very valid point, because we always have to look ahead. And I believe that there will still be growth, and we are going to get stronger, and we are also adding up a couple of cities. So that will also add up to the top line. So we are quite positive on the way things are going. We are not only looking at pre-sales, we're also looking at delivery, because that's the most important, which I believe will give us that impetus for future. So in FY25, we'll be having a lot of deliveries that we had launched in the previous years, and that will also give confidence to the customers that yes, has delivered, which is the most important thing according to me.
But can you just break it up for us? You're saying that 20,000 crore top line on pre-sales is what you are targeting by FY24. But, you know, to achieve a number like that in FY25, how many projects will be commercialized in the second half of the year? And you're saying you're fulfilling a lot of the earlier projects as well. Can you just give us a breakup of what one can expect in terms of commercialization of projects in FY25?
See, now, if you're looking at FY25, we have a strong pipeline. We have a strong pipeline again in Bangalore, in cities like Hyderabad. We just picked up some land in Budwell in a government auction. That's also a 27-acre land. We've paid for it. And then we have some good premium locations in Hyderabad as well as in Mumbai now. Mumbai, we've got the launch of, which will happen in FY24. But that will spill over to FY25 also, which is the Ocean Towers as well as Prestige Nautilus. Now, these two are very much there. And then we've also got the Prestige Forest Hills, which we haven't yet launched in the Prestige City in Mulund, because the first two phases are going into fruition. Like in FY25, our target is to complete the Siesta Tower and the Prestige City. FY26 is to try and see that we complete Belenza in the Prestige City, and at the same time launch the Forest Hills in FY25. So there's a lot happening, and we are looking at cities like Pune, Goa, NCR, and that will also add to the top line. Of course, Chennai is also there. Chennai is definitely going to add a lot to the kitty. So that's there's a large project which is almost ready. As soon as the approvals come, even that will come up for launch. So all in all, I believe that there is a lot of traction, and I believe there's a lot of opportunity. And only thing is we have to do it right, we have to do it properly, and we have to price our product also correctly.
Sure. You mentioned that there are some good premium locations in places like Hyderabad that you're targeting. Would this mean that you can better your realizations? Because your realizations have improved. I mean, it's at a multi-quarter high. Now you're sitting in average realizations around 10,000, almost 10,370 rupees per square foot. Is there scope to improve it further in the quarters to come?
See, the 10,300 is a blend of the various cities that we operate in. Like Mumbai gives me a much higher realization than a Hyderabad, or now, of course, Bangalore has in most of the locations, it's touching the 10,000 mark. So I mean, it's a question of not increasing the price just unilaterally and for the sake of increasing. We have to have a eye on the bottom line while we do that, but at the same time, not get too greedy and increase the prices, which will be counterproductive. I've said this before, I'm saying this again. We have to balance the price. At the same time, we have to see that the company's bottom line is also properly protected, and we do proper justified business.
So I'll come back to the numbers in the residential space in a bit, but in the commercial space also, you've completed projects of almost 40 million square feet, and you have some ongoing projects of 24 million square feet. can you tell me what could the exit rentals look like for you? What is the kind of annuity income you're looking at by the end of FY24 and 25, and what would this growth be?
Now, currently, we have an exit rental of about almost 250, 300 crores, 300 crores, I think. Now, that by FY28, whatever we are doing in the various cities, we believe it is going to touch 3,000 plus. There's a complete worksheet. Now, it's impossible for me to spell all of it on this show. But the target is that by FY28, we should have a top line of more than 3,000 crores on rentals. And we have to also add to it the retail mall portfolio. We have a strong portfolio on the mall side. We have now 3 operating malls, of course, 2 large, one in Bangalore, which is South Bangalore Mall, and the other is the Kochi Mall. But then we have a strong pipeline of many more malls under construction. And even that will add up to about 500 to 700 crores by 28.
And what is, okay, so 3,000 crores rental annually is what you're expecting by FY28. That's the top line there. But what is the occupancy like in Q2, and what are you planning to end the year with in your in the hospitality space?
Hospitality is doing well. Now, you just asked me what is my occupancy in the commercial space. Occupancy is actually excellent. It's in the high 90s. And we believe that whatever space that is getting leased out, completed, will get leased out. Like we have recently leased out a building that we were constructing in Pune. That was a one-off building that we did in Pune, and almost 1 million square feet, and we've leased the whole single building to Bank of New York Mellon. So that's a great deal that we've done. Similarly, we are in whichever city we are working in, we have got our tenants. It's only because of the location and the quality of the product. And that we believe we need to keep on upping our game and making our product better and better so that the occupiers come to us rather than anywhere else. So that's the plan that we have. And on the hospitality side, yes, the hospitality is buzzing. Hospitality, our post-COVID has been doing extremely well. We have 60% plus occupancy in most of the assets that we have.
Right.
The existing assets are trading very well. Future assets are under construction.
Mr. Razak, it's always a pleasure speaking with you, sir. Thank you very much for joining us, and good luck to you, and wishing you, if you don't speak again, a very happy Diwali to you, your family, your team, from all of us here. Thank you very much for joining us. Well, Hitachi Energy is the next company we're speaking with. It was a mixed set for the second quarter. So there was a 10% top-line growth, but down the line, things don't look all that well. There has been a bit of compression if you look at EBITDA, profits, etc. We have Mr. N. Venu, Managing Director and Chief Executive Officer at the company, joining in to take some questions. Mr. Venu, good morning. Great to have you here. Prashant this side. If you can just contextualize these numbers, what happened in Q2, and just give us a sense of the business. I mean, the 3 growth drivers for you, transmission, electrification, and renewables. How's traction in these 3 segments, and what's really going on? Go on.
Yeah. Thanks, Prashant. Good morning, and thank you for having me here in your show. And Q2, if you really look at our Q2, let me decode our results. Our orders, we had a very high orders, almost 50% increase in orders sequentially, and 36% increase in orders by unwind. And we also have a very good orders pipeline across the sectors, not only transmission and renewable, but also rail and other segments have contributed this high order growth in that. And resulting this is that we had a very all-time high order backlog of 7,500.
Right. Mr. Venu, we have the numbers. If you can explain to us qualitatively what is happening, because we have all the numbers. Is there execution issue still? You're not able to execute as you would like to? Go on. Yeah.
I'm coming over there. As we said, we have been having a challenges of supply chains, etc. previous quarters, and we continue to maintain that we are improving it. If you really look at our sequential performance, we have improved compared to previous quarters in that. That's how our improvement has coming, and our long-term demand drivers are intact, and our margin strategy, that is that By end of FY25, we want to get into double-digit EBITDA margin strategy is also well on track in that. So three things are playing at our thing. One is that our demand in the domestic market, our growth levers, which is exports and service, are also contributing this margin accretion sequentially over a period of time, and then that will eventually get us to 10% growth in that. And we're also saying that on the market standpoint, if the market is going X, we want to grow ahead in the market, and that has been also playing very well. And our strategy, give me another 30 seconds, our strategy of making in India, for India and the rest of the world is really playing very well so far in that. We are continuously maintaining almost 1/4 of our orders as well as our revenue coming from the exports across the geographies in that.
All right. Hi, Mr. Venu. Good to see you in. Nigel on this side. Well, sir, you have outlined things, right? Order book is looking good. Supply chain issues are behind you. And you're saying, you're going to outgrow the market. So that's good news. And that's what you've done actually in the past few years, though growth doesn't look that good. But you've actually outgrowing what your market, your industry is growing at. Now, tell us by the end of this year, what do you end up with in terms of growth? Will you grow in double digits for the year? Mr. Venu, will you grow in double digits for the year? For the first half, you've grown by close to around 8%. And your margins have been in the vicinity of around 5%. So will the second half of the year be much better? Can you grow in double digits for the year? Point number one. And can margins improve by, say, 100, 200 basis points? Because 10% is what you're targeting in 2025. So there'll have to be some improvement even in these quarters. Please go ahead.
Right. So thank you, Nigel. Good to see you again. So as I said, sequentially we are improving it. Okay, we have a very good portfolio, and our order backlog is very robust. We are able to execute. Our customers are picking up our products, whether it's a product, system, services. There's a huge demand, and the supply chain constraints have eased. There is a bit of backlog. We need to work on that. So, but having said that, our strategy is to grow ahead in the market. And the second half, definitely we will endeavor to see that we grow in higher than the market in that. And once we increase our revenue, and naturally we get a margin accretion, that will also help to further improve in this second half of the year.
So, Mr. Venu, going by what you're saying, for the year you'll grow in double digits. Second half of the year will be better. First half you grew by 8%. So, double-digit growth for this year, is it on track? And margin improvement will come about with operating leverage. So, can we have margins bottomed out? Do they move to around 7-8% for the second half of the year? Please go ahead.
I don't want to put any number there, Nigel. You know very well that all I'm saying is that we are improving it. We are growing higher in the market. And once we grow, then automatically the margin accretion will come into it, because we have a very nice portfolio, mix of broad-based segments, and also both domestic and exports, as well as service. Digital should contribute for the margin accretion.
Okay. Well, since you mentioned exports, I want to talk a little bit about that, sir. In quarter two, your exports were at 25% of your overall order book, and the export orders went up quite a bit. I want to understand which are the geographies which are doing well for you, which are the segments which are doing well, and are you facing any slowdown? Because, there are a lot of geopolitical tensions right now, especially in areas that you operate in the export market. Are you seeing any hit because of that?
Yeah, thank you, Sonia. I think, the geopolitical challenge is extremely very big. All of us, we know that. But, India is very well positioned in that standpoint. But our exports, as I have been telling you previously, is a three-pronged strategy. The first one is, we have a certain global feeder factories where the product is in Hitachi Energy globally. We only manufacture in India, and then we sell all over the world. That's the number one. And the second one is we have certain allocated markets, and then where we go and develop the allocated markets together with the local organizations, and then we sell our products. And third one is they have the feeder factories where we make the components to sell it to the rest of the Hitachi Energy factories. So far we're not seeing, in fact, we are seeing a lot of the pipeline is very robust in the export market. And as you know that we have set ourselves the target of 25% by 23. We have reached 1 year ahead of the curve. So right now we are stabilizing. We are in the range of 25-26% coming in that range. So there's a good pipeline at this point in time on the export projects.
So you'll stick to this target, right? 25% of your order book. You don't want to grow it further. Okay, got it.
Not that we don't want to grow further. We want to stabilize 25% and then take it up to the next level of growth.
Okay, got it. The other space I wanted to ask you about, which is really picking up now in the domestic market, is EV charging and this whole, railway and metro space. You do have about, I think, 40% market share in railways already. What are the incremental orders that you're getting in there? Can you just quantify it for us? And also in EV charging, this entire space, this ecosystem, what is the kind of potential that you see?
So, the rail is one of our key growth segments. And, if you really look at orders from this segment in the range of 15-16%, ballpark coming from these rail segments alone. And the rail segment, the market is going up. And if you recall, to 1 quarter or 2 quarters back, I put it up around 5,000 to 6,000 crores as the total market for the rail for our addressable market. Today, this market has gone up to 8,000 to 10,000 crores because we are coming up with a Vande Bharat trains and the cross-country electrification, metro train projects, and 9,000 horsepower trains. So all those things, help our, our technology can help in those segments as well in that. So it's quite a big market, and the market is really growing much higher.
So this may seem a little tangential, Mr. Venu, but on the transmission side, last time also when you were here, you were saying that that's the market which will grow very very rapidly, right? But on the is exports and transmission work on the export side also a big opportunity? I mean, rebuilding efforts in a lot of countries. I've heard, by the way, from companies talking about the opportunity, for example, in Ukraine, as that country comes out of the conflict, and you would need a fair bit of rebuilding. I'm just, is that something you're looking at?
No, the energy transition and climate action plans are really bringing a lot of opportunities in the transmission segment, especially on the HVDC, power quality, STATCOMs. Those are the one, for example, in the last quarter, we have booked one large high-powered STATCOM orders, a couple of 100 crores. And that's a example to show that, how these renewables need this kind of technologies. And I've been also telling in your show that, India as a country was requiring one HVDC project for every 4 to 5 years. Today, the need is every year one project, which is almost 6,000 to 8,000 crores worth of project per year. So those are the projects are coming for bidding, and they are quite a large projects, and where our company has seen this, and we are invested in our factories expansions. In the last 1 year, we have inaugurated the 4 new greenfield projects, factories. In catering to these kind of projects in that. And exports is also another opportunities where we are looking at it, both our HVDC and the STATCOMs, the factories which we have set it up here, they are not only meant for domestic market, but also for the export market.
Okay, all right. Mr. Venu, very quickly before we let you go, you're not giving us a guidance for the year, but you're giving directional outlook, so that's good. But tell us on the order book. The order inflows this year have been very, very strong. I think it's more than what you saw in the entire of last year. So what is the total order inflow you're looking at for this year? That's for FY24 by the time you wind up. And also you have bid for various orders, right? So what is the total bid size that you're looking at? I mean, what is the total size of projects that Hitachi has bid for? Please go ahead.
So again, the pipeline for us is very, very robust. The pipeline today, if I put it, is at least 50-60% more than what it used to be in the last year. So that tells you that, and our hit rate is quite high. It is in the range of 30 to 40%, depending upon the sector, segments, etc. So based on that, one can always make an assessment then where we're going to land it up. We are right now, our factories are getting full. So we are working with our customers, de-bottleneck some of those, issues of the delivery times, etc. But otherwise, the market is in a fantastic at this point in time, Nigel.
Okay. And you want to put a number, sir, to it?
Number. What is the market is growing X? We want to grow much higher than X.
Okay. Well, the much higher can be anything, right? It can be 2x, 3x. It can also be 10x to the market. So that's what you're trying to get at. But I think your service contribution, right? You have a plan to get it to 15 to 16% in the next 3 to 4 years. Currently, your services contribution to the order book is in high single digits. Can you tell us what is the outlook for FY24 and FY25?
So we have now very close to the 10% mark of the service, because service, we have a huge, install base in India. We have been present last 75 years. We have quite a lot of install base. So we are now productizing this service offerings to our customers, including life expectancy, life enhancement of those things, and also digital service Those are the things would get us from what we are now from 10% to 15% in the next 2-3 years time in that. And as you know, the services have better margins, and that would also help us in the margin accretion going forward.
Services and exports, I think both those two will be drivers as well going ahead. It's always good speaking to you, Mr. Venu. Maybe by the end of the third quarter, you'll give us some more concrete numbers. One number we have is you're going to be moving to double-digit margins by 2025. On the growth aspect, we'll have to see how execution is picking up. But all in all, thanks so much for joining in and filling us in with a fair sense about how the business.
Very happy Diwali to all of you. Happy Diwali.
Likewise.
To all of you.
Wishes to you as well as your entire team, Mr. Venu. Thanks so much for joining in. Well, for the time being, though, we'll slip into a short break. On the other side, we'll focus on the commodity sector. Manisha Gupta is joining in.
Welcome back to Corporate Radar. For now, we have a quick update on what's happening in the world of commodities. Manisha Gupta is joining in for that. Manisha, hi, morning.
Morning, Sonia. I'm looking at the crude oil prices, and what a sharp decline is what we're looking at into this one. We're trading at a 3-month lows. Overnight has been a 4% decline, and with that, for the week as well, we are down by 4%. Last week was a 6% decline, and for the month of October, it was a 10% decline. So it has been a one-way move for the crude oil prices, and that clearly has been on the weaker side there. Well, we have seen a steep rise in the U.S. inventories, and that really seems to be weighing on. The U.S. consumption also seems to be slipping down, and that's what's bothering the markets. If you look at the inventories itself, the expectation is that you could have seen 12 million barrels of a rise come in for this one. The U.S. consumption is down by nearly 300,000 barrels versus a rise estimate of around 100,000 barrels. This is the latest report from EIA also telling you. And then you have weak China data, the trade numbers that came in yesterday, and with the export numbers coming in way below what the street was anticipating, has been weighing on. Now the street will watch out for the Chinese inflation data that comes in on Thursday then. And then Israel is also considering tactical pauses when it comes to its conflict with Gaza. There also is no other Middle East country joining in. There is no impact whatsoever on crude production or export from that area, and that has taken the whole of the war premium off the prices as well. And the markets also are looking at the Saudi Arabia and Russia output cuts, where they have reiterated that it will continue until end of December. But with the demand as well declining from China, from Europe, from US as well, this clearly hasn't had much of an impact into the markets. I will want to take you to a volatility picture that we've seen in this year when it comes to the crude oil prices. We started with $82 a barrel and then saw a sharp decline up to $70 a barrel in the month of June. That is because the first 2 quarters of this year did not see any demand change from China. The economic data continued to be on the weaker side, and that took the prices to a nearly 10-month lows there. And then came the month of September, where we saw OPEC and allies continue to cut production with an expectation that you could be looking at a big deficit in this quarter and the next as well. And that led to a huge amount of hedge fund buying that took the prices to $96 a barrel. And then we saw prices see some profit taking by the month of October. And then came the Gaza and Hamas conflict, which again took the prices back above $90 a barrel. But clearly with that war premium going off right now, we are back at $81 a barrel right now. So it has been a $10 of a decline in last 3 weeks that we've seen come in for the crude oil prices. Another important number to watch out for is the demand expectation for the next year now. So while we've seen a strong demand from a previous year, the next year demand expectation is much on the lower side on an year-on-year basis, much lower when it comes to IEA. OPEC also believes that next year is going to be a strong demand growth, but less than what we saw in this year, and that also seems to be bothering the markets right now.
Okay, thanks a lot, Manisha, for that. Let's slip into a quick break. On the other side, we'll get you a Diwali special. Lata will connect with Renuka Ramnath of Multiples Alternate Asset Management and S. Srinivasan of Kotak Alternate Asset Management to discuss the market and the way ahead. Stay tuned.